the vol wiped out my winners. When I hear that, I kind of think there's something really wrong, and it's not the vol. So let's talk about it. If you're in a position in the E-mini and you're up $100, and the market comes back on you, so that now the position is flat, that's not you really giving up a winner. $100 unrealized gain to me isn't worth getting out of bed. So you probably have to look at, even if you have a smaller account, it's not enough money, because you have to figure, if you had a job and you were making minimum wage, what would an 8-hour day look like in terms of getting paid? That's what I'm talking about. Too many people are trading, looking at small gains and thinking dollar values like that as opposed to percentages. So that to me isn't volatility. And two, if you're looking at vol as a percentage of the ATR, for example, you need to get a better understanding of how these things move. Because when I hear comments like that, I just think that there's a fundamental misunderstanding on how trading works. And that's no reason to get psyched out, especially in stocks. If you have breakouts that move up, very frequently you'll have it pull back to the breakout point as a retest. Hopefully it holds, but that's kind of the nature of the beast. So if the vol is bothering you, just generally speaking, the best thing that you can do is to position size to a point where it doesn't bother you anymore. But again, you have to realize that if your goal is financial abundance, creation of wealth, not greed, I'm talking about, just seeking the abundance that you deserve, then you have to position size to a point where if the thing moves in your favor, it's going to mean something to your overall bottom line account, right? Your 3-to-1 can't be 1/4 of 1% as a rate of return on your account, because again, that's the kind of stuff we're talking about here, in that you'll never become wealthy, doing that. It's too small. The other way, obviously, is to trade larger, but in volatile markets, you can see if you add the ATR to your charting software, you can see how it changes over time. And so, naturally, if you can do that ahead of time, then you could also calibrate your emotional constitution to not get psyched out. But, for everybody who's sitting at home looking at 1 minute bars and you got 2, 3, 4 points on the E-mini, that's like a good starting point, but that's nothing to write home about. That to me, so that whatever, what's $200, 4 points on the E-mini is $200. If that $200 comes back down so that your account is flat, that to me is not letting a winner become a loser, because it's not enough of a win to be significant. You see what I'm saying? Like that, you don't know that could be noise. And if the ATR is actually 40 points, who cares about 4 points? You're only 1/10 of the daily vol. So that's not volatility knocking you out of a winner. And so you might be playing out drama with yourself or looking for attention. I don't know, because it's hard to say. But I wouldn't look at that as vol knocking you out of your winner. A winner would be something that has much greater statistical significance, again, to your account equity. Now, if you ran something up 40 points and it came all the way back, that would be something to look at. It does happen from time to time. If it happens very, very frequently, you may have a reluctance to, put in your protective stops. I have consulted to folks who, were looking or, bought something at $100 a share, put in a protective stop at 95, and still had that stop in when the thing was at 125. Right? That obviously doesn't make any sense. And I'm a guy who likes to hold on to my winners, but you have to adjust the stop. You could set up a process around that. A good way to do it is that, if the ATR is say 10, every 5 points or 1/2 ATR, you can adjust your stop higher. You could also, so it all really depends. I can't do it here on the video, but it really depends on what your R is and then what that R means to you in terms of ATR, like as a percentage of the ATR. Because a lot of folks, don't give the thing enough room because they're so afraid to lose money, which again is fear. You have to be willing to lose money on the initial trade. And in my opinion, if you want to trade and make big money, you have to be willing to give back some of your unrealized gains. You see, in order to make the big money, if that's your goal. If your goal is to play out this thing about fear, you really have to look at your behavior, which is why I say, kind of tongue in cheek, so much about trading isn't really looking at charts. It's about looking at your behavior. but it's the hardest thing to fix because it comes from years and years of conditioning that have seeped into your subconscious. And some point times you don't even know what it is that you're doing. Some of these things you've learned from your parents or your nuclear family or whoever you spent a lot of time around, and it seeped into your subconscious, and now you're acting out on it and you don't even know why. But for me, I knew again that I needed to invite not reckless risks, but bigger risks, because risk and reward goes together. And if I didn't grow my assets substantially, not from an ego, like look at my 3-4 figures rates of return, it was more like I needed the dollar values at that point. I needed to grow my asset base so that I could better diversify, but also take advantage of more opportunities. Because when your account is smaller and you're trying to trade futures, you could end up tying up a great deal amount of your money in the initial margin, which means you have to make choices, especially if you're a discretionary trader. How do you know what to use or what instrument to put in your portfolio if you have to make one decision over the next because your account is too small and it ties up too much margin. So be mindful of that. Be kind to yourself and fully understand that, these choices they become easier the more you practice them. Like anything else, our emotional system, you can really figure out what your emotional system is when you look at the sum total of all your habits. Because a lot of the things that you do come from pleasure seeking. Because we might be running a discretionary trading model, we might be running a systematic trading model, but every one of us is running also an emotional model concurrently with either of those models. Now, the parameters and the touch points might be similar, but we get to those feelings very, very differently. But we still feel them, right? Because we're human. We can't eliminate emotion from who we are as people. The question is, it could come down to trust. Do you trust yourself? Do you trust the markets? Do you trust the integrity of things? But, to be afraid of losing money is an awfully difficult place to be if you want to succeed as a trader. Because, as I like to say, you might not necessarily want to go pro, but in order to make pro-style money, you have to do the things that pros do, like behaviorally, right? And when you do that, you understand that losses are part of the business. So you have to find a way to get comfortable with that. It's really impossible to take any type of risk and not have loss. And I think if you're struggling and you're coming into, we are in Q4 of 2023 and you want to have a better 24, you might want to take a look at your understanding of trading and what it actually means. Because a lot of you are going for the more accurate style systems because you're so afraid to lose. Those systems typically have much smaller gains. The benefit of actually having a system with longer term holding periods is the payoff is much bigger. But if you're not willing to deal with the uncertainty, which is emotional risk, then you're fucked, basically. I don't want to be the guy to tell you that. But so you can make nickels and dimes and work like a dog for minimum wage, or you could let the market do the heavy lifting for you and just have the wisdom to get in at the right time and then let the market, force yourself using your stop orders to effectively and very frequently put yourself in the right place at the right time. You won't win all the time, but when the trades do work out, everyone else is going to have to pay you for a trade that you've already been in, and all you have to do is sit on your hands. So that's an emotional decision. Again, talk about yesterday's episode. Go back. If you study the data, you can kind of see for the instruments that you trade, how would those daily moves in the instrument affect your overall equity of your account? I'm going to venture to guess that it's not as bad as you might think, but you have to put the work in. It's not going to change just by ideating it. You actually have to do the work, and that means trying on the trade for size. You see? Anyway, appreciate everybody being here. I'll be here tomorrow with Ganja, and then I'll be there Thursday and Friday again by myself. So thanks very much for being here, folks. I'll see you then.